Good morning, Richard Calhoun, real estate broker with Creekside Realty, here to discuss Silicon Valley real estate market using graphs. We're here to talk about week number 4. Please ask questions as they come up. These URLs get you to the different components. We'll get back to that at the end for those that don't know about them. Week 4, we're going to start off talking about Silicon Valley. We will then later get into the greater Bay Area. Silicon Valley is Santa Clara County, San Mateo County, and Alameda County. It consists of slides 3 through 61. We're talking about single-family homes, detached and duet. We use 5-week moving periods, and we use a 10-year reference period of 2014 through 2023. Wanted to bring up 2 slides. I don't expect you to read this, but basically these are the big takeaways. We're only selling 860 homes in 5 weeks, which is a record low in the last 25 years, as you can see from the highlights. So this is the real takeaway. In 2022, just a year ago, we were selling the most homes that we ever had. We quickly went from the most, we quickly got down to the least or second least. I've only highlighted the weeks that we were the second worst or the worst, fewest number of transactions. This first column is on a 25-year basis, and the second column over here is on a 10-year basis. So very rapidly, we went from a very robust market with a lot of activity to a very little activity. This slide is up here for another interesting observation. Santa Clara County median price is $1.5 million. San Mateo County, which is normally more expensive, is actually $20,000 lower at $1,480,000. San Francisco is $100,000, as well as Marin $102,000 less. For the first time that I'm aware, Santa Clara County is the most expensive county in the greater Bay Area. So I just wanted to bring that out before we delve into the data. On my heat maps, unfortunately, I was troubleshooting a problem with my maps from last week in Alameda County, which there was one. They were cross-reporting, so I was reporting correct data, but for wrong geographical areas. In my effort to fix it, I blew it up, so we're back to just San Mateo County and Santa Clara County for this week. I hope to be able to restore Alameda County next week. We're back to just San Mateo County and Santa Clara County, but days of unsold inventory is the key indicator. The lower the number, the faster the marketplace. So a fast marketplace is indicated by red. So the hottest area currently in the 2 counties is Milpitas, Berryessa, Santa Teresa, and Blossom Valley. And that's basically at 37 days of unsold inventory. The slowest days right now is Los Altos and Palo Alto. It's 171. Right on its heels is San Mateo County expensive areas, Menlo Park, Atherton at 167. Not far behind is the Coast at 162. And then Saratoga and Los Gatos at 93. If you look at that, it's all your expensive areas. A lot of times your expensive areas are the hottest areas. Not true for Saratoga and Los Gatos, but the northern ones tend to be very aggressive. Right now, they're the slowest. But a fair amount of Santa Clara County and even the base side of San Mateo County is in what I would consider to be a balanced marketplace. We're sort of having this almost oxymoron where we have very, very low number of transactions, but the transactions that are happening relatively quickly. Moving on to magnitude of overbidding, nobody is getting what they're asking price. I am missing Alameda County again on this map, and I think one of their areas was at 100, and it not 107 that I had the week before, but just slightly over 100 if I remember correctly. But you can see we're still fairly respectable. Everybody's pretty much above 98 or at 98. South County is at 96.5. Los Altos, Palo Alto, 95. So there's a few exceptions, but when you look at this, most people are between 98 and 99% of their asking price, and that's their asking price at the time of acceptance. This is how common overbidding is, how frequent people are overbidding. So red color, which is non-existent, would be more than 50% of the sellers getting more than their asking price. Every area that's blue is less than a third of the sellers are getting more than their asking price. And again, that's at the time of the offer. And this is price has nothing to do with market conditions. Blue is below the median price. Red is above the median price. And Bay City's median is 1.9. Redwood City is basically 2 million. So again, this week, Redwood City is more expensive than the Bay Cities, which is another one of those price reverses that's going on. Now we're looking into the data graphs. We're looking at the number of active listings compared to the 10-year normal. So normally a lot of inventory would be a slow marketplace, which is the blue line. That's basically the 90 percentile out of the last 10 years. Low inventory would tend to be a hot marketplace, which would be the 10 percentile, the fewest number of listings out of the last 10 years. The thin black line right there is the median, which is where you'd expect it to be, and the purple is where we are. We actually have a little bit below the expected level of inventory. Again, that sort of doesn't really make a lot of sense that you're selling very, very few homes, the record low number of homes, but yet there's a little bit of a shortage of inventory. Here's the number of offers that accepted, and here's where you can see where I've been saying, here's where the blue is the least number of offers you'd expect, the black is where you'd expect it to be, and the red's the most you'd expect. So basically you'd expect somewhere around 1,500 homes. We're down here, and I think I said the number earlier was 860 homes. So we're selling way fewer homes than we would expect to. Not quite, a little bit more than half, but maybe 60%, just taking a number off the top of my head. Actually, that's about right, because if you're at 1,500 and take 60% of 1,500, that's 900, and we were at 860, so we're less than 60% of the volume of transactions that you'd expect. Here's the number of closed, very similar as the previous chart. The previous chart was number of offers accepted. Closings is basically typically that same data delayed by about 5 weeks. Here's days of unsold inventory, and so again, now it's the reverse side. We're up here, very high number, so even though I'm saying it's a rapid marketplace, and I'm saying it's a rapid marketplace because you're below 60 days of unsold inventory, somewhere around 57.5 days to sell all your inventory. And if you went to almost anywhere else in the country, they would say that's a great marketplace. But normally, based on the last 10 years, you're sub 40. You're somewhere down around 38 days of unsold inventory. So you have an extra 20 days of unsold inventory, and an extra 20 days when you're talking about a number around 38 is fairly significant, but it's still a fairly fast-paced market. Here's median days on marketplace. So the median now is somewhere at 25. So it's taking the typical seller almost a month to sell their property. You can see typically at this time of the year, sellers would expect to be able to do that in about not quite half the time, but about 18 days. Moving on to days on market. This was my effort to try to make it make sense for a few people that were struggling. This is the 75 percentile. So this is sort of the typical longest seller on the marketplace. Yes, there's going to be sellers that are a 90 percentile, but this is the top quadrant. All but 25% of the sellers are selling their house in about 51 days on the marketplace. In a hot marketplace, that's down around 23. In a cold marketplace, that's up around 53. So we're pretty close to a cold marketplace. Here is the price reductions. And I'm starting to do this because I thought it would help us get an idea of what's happening to the marketplace without needing to wait for the escrows to close. To get sale price, escrows have to close, so you get a 5-week lag time. Here you're looking at what's happening to the seller's asking price compared to their original asking price. And so you can see that we're basically at an all-time record low. Here's this year, a couple of weeks ago, it was an all-time record low. Here you're an all-time record low for this time of the year, because a couple of weeks ago you would have been lower a lot of these past years. But the least you'd expect for this week is somewhere around 93 and maybe a quarter, maybe 93 and a third of the seller's asking price. And instead we're down here around 91 and 3/4. Sellers are taking more price reductions. They're only getting, they're at the time the offer is accepted, they're only asking a little bit less than 92% of their original asking price. So that's basically the typical sellers taking an 8% price reduction over their original asking price. Now, of course, it depends on where you put your original asking price, but this is sort of everyone blended together. This is the 10 percentile. This is the average. So this is everybody put in a blender. The average is used so that you get rid of the plateaus here where you're at 100%. You can see that all these lines spend a fair number of time at 100%. I think this is interesting because this shows the most price reductions. This is the seller that's taking the most price reductions. So that probably should actually be the 90 percentile, not the 10 percentile. Here's the average seller. So the average seller is not taking an 8% reduction, but taking a 2% price reduction over their original asking price. Here's Silicon Valley overbids. Now, this is the lag time. So this is where you're looking at actual sale price to list price. So right now you can see we're below 100%. And if you can, and it's almost hard to fathom this, but in the last 10 years, the average seller never took less than their asking price. Yes, some sellers took asking price below, but there was several sellers that were taking more. And in the last 10 years, when you blend all that up, on average, they were never taking less than 100%. Now we are. That's pretty significant. We're basically at 99%. Again, you go almost anywhere and say you get 99% of what you're asking for, and people would be pretty happy with that, but not here in Silicon Valley. This is the frequency of overbidding, same concept. The red is the most you'd expect, which is about 73% of the sellers getting more than they're asking. Typically, we'd be somewhere right around 53%. The least you'd expect to have is somewhere right around 36%, and yet right now we're coming in somewhere around 32% of the sellers getting more than their asking price. And you can see that trajectory is straight down, which is a little unnerving as well. Now you're looking at the magnitude of the median. So this is the midpoint. And here you're starting to see a little bit of a turnaround. See how this week is up from last week. So last week was the low, then you're back up again. And you can see the gray line is sort of bent around and the red line's bent around. So we're starting to follow the normal projection. The reason for the difference between the two is this is the midpoint. So it's more receptive to changes, which is one of the reasons you look at your quadrants. This is the sale price over time for Silicon Valley. You can see that we're now basically back here, and it depends on where you really draw the line, but we're approaching the prices at the beginning part of 2021. We're not quite back to where we were in 2020, and that's for Santa Clara County, Mateo County, and Alameda County single-family homes, detached and attached, but not townhouses or condos. Here's just, again, essentially the same slide, but it's on log scale, and this is not computed, this line, it's just me freehanding it, but that's basically your rate of appreciation. And you can see that prices got overinflated in 2021 and 2022, and now in 2023 they're underinflated. So this is where you start getting price stability, and then you start going back up. So long term we should be following this blue line. Now we're going to go into a little movie essentially, and we're going back a year, and yes, this is January 24th. That's because that was Tuesday. This is based on my fiscal real estate year of March 1st through February 22nd, I think it turns out to be, and then starting over again on March 1st. So you're comparing the same days to the same days. So we're comparing January 24th of this year, which was Tuesday, to January 24th of last year. And at the very end, we'll come in with a +1 week where we get to the current data. The red up arrow indicates an improving marketplace, blue down arrow, decreasing marketplace, both as a plateau. Here's where we were. Here's your best line ever, the red dotted line. The worst dotted line ever is down here, and the purple is the current data. Now we'll step through 11 months ago. Huge improvement right at the peak at 10 months ago. Slight deterioration, so I called it a plateau. Significant deterioration 8 months ago, 7 months ago, 6 months ago. So you can see it's just stepping right down. 5 months ago. 4, now it's going to start stabilizing right there. 3 is right on top, and we're going to have a plateau for quite a long period of time, but clearly it's going to deteriorate again to get down to the current data of purple. 9 weeks ago is still in that plateau. 8 weeks, 7 weeks, a little hint of on the downward side, another hint on the downward side, but I still called it a plateau. Another hint down, but plateau. Now you're starting to step down. Where you call that step down is hard to say, but somewhere between about 7 and 4 weeks ago. 2 weeks ago was, now you're down again, down, and that's your +1 week. So the +1 week is looking at sort of what I anticipate the market to be next week. And there's no way to know, but what you basically do is you look at the data that's already in the bag. In other words, if I'm looking at the data on January 31st and I'm going back 35 days, the bulk of that data is already in there, and that's indicating it's a little bit better than this past week. That's good news. Here's your market conditions. I think Oakland and Berkeley and Alameda County are reversed. Alameda and Berkeley would be more expensive than Oakland. So I think these two are reversed. Then I think Hayward and Newark are okay, and Fremont looks okay. I think everything's okay except for I think Oakland and Alameda are reversed. So these two bottom ones are reversed, but I'm not sure on that. Let's ignore Alameda County, and I apologize. I should have checked. I knew my maps didn't work. I didn't realize my numbers may not have worked. Anyway, DUI, you can see the DUI at the different levels in the different micro market areas. The more blue, the slower the marketplace. The magnitude of overbidding, you can see is very blue. Frequency of overbidding is very blue. And price has nothing to do with market conditions, but simply whether you're above or below the median price. Here's DUI for the micro market areas going back over time. And you can see I had last week in Alameda County, but I lost it for this week. Here is the breakdown of the raw numbers. So Silicon Valley is the three counties combined. Then you have the breakdown. And again, you should be able to see the numbers down here. San Mateo County at 1,480,000. So that's pretty unusual for that to be lower like that. But you can see that San Mateo County has only had 92% appreciation over 2020. So they've actually lost, what would that be? That would be 7.4% of their equity over the last 3 years, where Santa Clara County has gained 10%, 9.5%, which is the reversal. Alameda County is at 4.5%. And again, it sort of looks like an oxymoron, but you have 117%. You have 17% appreciation for the three counties for Silicon Valley combined, but the biggest area that you have is 9% in Santa Clara County. And that's just based on the market mix. Basically, anything over $1.1 million brings up the appreciation for the three county area. So even though San Mateo County is down, now at 1.48, that's still above the county average. So selling homes below the median in San Mateo County brings down the median in San Mateo County, but raises the median for Silicon Valley as a whole. And that's how you can get that. That's one of the reasons I'm a firm believer in micro markets instead of, macro market. The media is a king of macro markets. They typically report on what happens to the Bay Area data. And I'm saying there's a huge difference between 17% appreciation and a 7% depreciation. That would never get picked up by the media. Here's a slide we talked about earlier, so I'll just fairly quickly skip over it, but basically we have record low volume of transactions. Here we're comparing apples and oranges to some degree because I'm looking for January data to not look back in time, but I won't have that data till February 5th, so we're still a little bit more than a week away from having that data, but you can sort of get a hint here where inventory is 525, and that's right in line with what it's been in the last couple of years, which is what my inventory chart said. And this is for Santa Clara County single family detached homes only. Days on market, down here, you can see median is 19. That's basically much higher than we've had any time since 2012. Clearly, it's taking sellers longer to sell, but still 19 days is relatively quick. The big takeaway, again, is the number of transactions. We're sitting here with only 339 transactions, and you won't see a number anywhere close to that low anywhere in the past. Get down to asking price or sale price down here, 98% is the typical seller. Only 28% of the sellers are getting more than their asking price. Now, if you go back to what year is that, 2012, you can see that only 27% of the sellers were getting more than their asking price. So, but the magnitude was higher at almost 99%. So the fact that we're at a whole percent lower, I think is the fact that we've come down so dramatically in price. And again, you're seeing the median price at 1.5 million, which is lower than it was last year at 1.6 million. And I should make a note to myself of what the number is, but I believe the highest median for Santa Clara County single family homes was somewhere around 1.985, so almost 2 million. Here is comparing apples and apples, but it's going back to December, so it's getting pretty old and I won't spend any time on it, but it's there for those that like numbers. Here is now the breakdown of the three counties that we've been talking about. We were sort of talking about Santa Clara or Silicon Valley. Now what we can do is you can see the three counties by themselves. San Mateo County is the smallest, so it has the least inventory. Santa Clara County and Alameda County are very close together. You can see the patterns are all the same. I'm sort of noticing, and I haven't compared the actual numbers, but San Mateo County, it's got the same pattern as Santa Clara and Alameda County, but the magnitude shift is not as much. In other words, you go from 200 homes here to about 500, so you're doing 2.5 times. And for Santa Clara County, you go from 600 and you go up to 2.5 times 600 would be, actually, it is about the same. I guess that's why you do things on log scale. So even though this is covering a lot much more vertical distance, which gives you that optical illusion of being more unstable, when you do the multiplier, it turns out to be the same. Here's the number of offers accepted. The trend is the same. You can see that both Santa Clara County and Alameda County are starting to improve. Both Santa Clara and Alameda are improving. San Mateo County is basically plateaued. The two data points look like they're essentially identical down there. Here's days of unsold inventory. You can see that San Mateo County is the slowest, which is part of the reason why they've had price depreciation. Sellers that have to sell have to reduce their price to get the buyers to buy. When you start having large number of DUI. DUI of, north of 70 for San Mateo County is pretty high. You can look back over the track record. The slowest I'm seeing, was at the slowest time of the year, which was a couple weeks ago or, close to right now, was 60. The typical low is down here closer to 50. You've gone from 50 as a sort of a top end to 70. So that's pretty significant. Here's that 75 percentile days on market. So this is how long it's taken the typical longest seller. The longest seller is going to be out there at probably over a year, but 25% of the marketplace is the top quadrant and becomes somewhat statistically significant, which is why statisticians look at that quadrants. But you can see that Santa Clara County is down here somewhere around 50 days, Alameda County somewhere around 60, and San Mateo County somewhere around 75 days. Average days on market is where everybody's in a blender. It's more commonly used. I think the quadrant is more meaningful. Again, Alameda has got the lower down here at about 34.5 maybe. Santa Clara County looks like it's about 36 or 35 and 3/4, and San Mateo County is doing the slowest at about 44 days. This is the median days on market, so half. This is dropping so rapidly now, and if you go back and look at it, you can see it drops it every year at this time of the year, and that's just because a lot of new listings are coming on the market that have 0 days on the market, and the new inventory is what tends to sell. So the 50% of the sellers that are selling are improving fairly rapidly at this time of the year. It's not that the market's improving, it's just a matter of what's on the marketplace. Here's price reductions. This is list price to original list price. So this allows you to see the softening of the marketplace without the time delay for close of escrow. You can see that we rolled over. And, this is sort of interesting because here's April 1st. And basically by April 1st, it clearly was coming down. But when you really start looking at this, it started to actually roll over much earlier. And I would almost say like February. And since the peak pricing, sale price to list price ratio was the end of March, the peak of the marketplace was probably right back in February, not far off of like Valentine's Day, somewhere in that time frame. And this shows it a little bit more. When you start looking at sale price, you look like it's more like almost in May before we rolled over, but clearly the market was changing earlier than that. And here you're sort of seeing the ask price ratio. So right here, you're clearly here. This vertical line is April 1st. So, it's not May, but it's, April 15th. But again, if now that you know where the market went, you could actually start saying it maybe started rolling over in the month of March. But again, the previous slide with the price reductions would indicate, as I said, probably more like February. You can see that sellers are still coming down. This is because the lag time. By the time escrows close in another 5 weeks, what's happening right now is these numbers are probably coming up, but that's the lag time. You don't know. You're sort of running blind. Frequency of overbidding, we're basically down there. And if you look at the blue line, it looks like it's up. The orange line looks like it's flat, and the gray line is flat. When the data is on top of one another, it's sometimes hard to tell. Here is the same sale price that we were talking about. So the orange is San Mateo County, which is normally above the blue, but now it's reversed, and they're close. The orange is basically 1480, and the blue is for Santa Clara County is at 1,500,000. So you can see that you have a reversal going on, and you can see that nowhere on this graph has that happened before where they've actually crossed over. And I don't remember that happening. Did not go back and look at data, Alameda, but I don't remember that happening anytime in my career. I thought it was unusual a couple years ago when I started showing property in San Mateo County when it got close at some of these points, but now to see that the actual crossover occurred is sort of an interesting phenomenon. You have no way of knowing on how long it's going to last. Here's the same data on logs, so you can see how Santa Clara County's catched up and now is crossed over with San Mateo County. Here's the appreciation. I used the real estate year of April 1st, 2015 through March 31st, 2016, and it's just the percent appreciation. The reason I picked that as my base year is prices were fairly stable. That gives you a good solid base. You can see that all three components did it pretty well, which is one of the reasons I talk about Silicon Valley. But you can see San Mateo County has really pulled away, and the question becomes, when did it really pull away? And I would say it started pulling away right here, somewhere around, maybe September of 2022. And it's been significantly lower and is now, fairly dramatically lower. Santa Clara County is up here and the two different numbers, this is over 2015-16 versus 2020. So the Santa Clara County is up somewhere around 157%, and San Mateo County is only up around 125% maybe. Now we're going to start talking about the Bay Area data, so I'll pause and see if anybody's got any questions. Not seeing any questions, I'll move on. So we're adding in San Francisco, Marin, Sonoma, Napa, Solano, Contra, Costa, Central Valley, San Joaquin, Sacramento, and the Central Coast of Santa Cruz and Monterey. I also have micro market areas for Silicon Valley. This is sort of a quick recap. It's in table form, so it's not very fascinating, but there's a lot of information here for people that want to come back. You can see each of the components. You can see Silicon Valley, and I think I hit it earlier. Here's San Francisco at 1.4 million and Marin at 1.4 million. Santa Clara County at 1.5 is the most expensive county in the Bay Area, and not only the Bay Area 9, but the whole greater Bay Area being the 13 counties. You can come back and look at the variation, the DUI, the number of offers. Number of offers, days on market, list price, is this information from this small gap to that small gap is based on offers accepted. Past here, you need sale price, so it's based on closed transactions. So this data is out of sync by about 5 weeks compared to this data. And then you have your active inventory, which is obviously by itself, it's active inventory, and you really don't know anything else. Here you're looking at the active inventory for all 5 components. So we're just looking at the 5 components. The color's the same. Purple is Silicon Valley. Marin is going to be the orange, the dark orange. The North Bay is the gray. Central Valley is the yellow, and Santa Cruz is the blue. Here's the number of offers accepted. You can see the patterns are the same. You got 2 smaller counties and 3 bigger groups. When I say counties, they're groups of counties. The smallest group is 2. I guess 3 of them have 2. North Bay has the most with 4, and Silicon Valley has 3. Here's the number of closed transactions. Days of unsold inventory. Very similarly, you can see that Santa Clara County was doing the best compared to all 5 groups. You can see 4 of the groups are pretty close together. Is the orange here, San Francisco and Marin. San Mateo would be part of the purple. Duh. Here is your median days on the market. You can see they are climbing. I would expect that to turn around and start going down. Here's the price reductions that we were talked about. And I guess how you look at this is the 90 percentile price reduction, but it's the 10 percentile, it's the lowest 10 percentile, which is why I put the 10 percentile. And the reason I use 10 percentile here instead of the quadrant, which is statistically a better number, is the quadrants are going to spend an awful lot of time right at 100%. You can see even the 10 percentile spends a fair amount of time at 100%, and you want to be able to see changes. That was a conscious decision. I don't feel comfortable going out any further than 10% because you just get into the noise level. Here's the price reductions. This is the average versus the 10 percentile. This is overbidding. This is so you can see the span. This is the least amount of overbidding you get, and you can see that you're down here right around 93% for most of the counties. So the coast is the lowest down here below 90%. 10% of your sellers in Santa Cruz, Monterey area are taking more than a 10% price reduction at the time they accept an offer. And that's pretty significant for Silicon Valley, spectrum. Here's your overbid, and you can see that we're below. And again, when you look back in time, about the only area that's 10 times below it is Monterey and Santa Cruz. Everybody else is mostly above, but we're all below now. Still basically above 100%. This is 90 percentile. When you're looking at the sellers that are doing the best and overbidding, they're all getting more than 100%. This is the average. The average is now under 100% for most areas. It looks like Marin and San Francisco are the only area above 100%, which is interesting because their price is now in line with Santa Clara County and San Mateo County. This is the frequency of overbidding. How common is it? And this is pretty significant also because we're getting pretty low, and I probably will have to increase my axis here in a little bit potentially. I bottomed out at 15% intentionally because I never saw numbers below 15. With the way that sloped down, it looks like it may hit there, but time will tell. With that, I'm done. We'll hit the URLs real quick. The green is what I call the root URL. That gets you to the archives on YouTube. If you add in 2023, you get the live presentation Saturday morning at 9 a.m. The handout is posted for this week. You use the root URL and add it at the end of it. H for handout 2023-01-28. I got it up about 10 minutes before the hour. My goal is about 15 minutes before. I was trying to chase down grumblings, and I got most of them. And then for any specific episode, you put in the green root URL and the 8-digit year, month, date code. So 2023-01-28. And with that, I'm done, and I'll see if anyone's got any questions. Not seeing any unmuted mics, so I'll call it a meeting. Thanks for coming. See you next week. Take care. Bye.